Good afternoon, and thank you for having me. It's such an interesting, unique time to be talking about the economic outlook and the outlook for travel. We're in the midst of the strongest economic and travel recovery that many of us will experience in our lifetime. Strongest and fastest. And I mean fastest not just in terms of the resumption of travel, but also the speed of the RevPAR recovery. So we're on track right now for a recovery of RevPAR back to its historical average within 3 years, which is faster than the 2 previous cycles. We're benefiting from a strong economic recovery. We have less of an overhang of new supply than we did in the previous recession. And we have improving public health conditions and pent-up demand. But the road forward is still uncertain. And so what I thought I'd do today is focus on 4 questions. Is the economic recovery still intact? When will disrupted travel normalize? Will a labor shortage restrain growth? And what's next for hotel pricing? But one of the things we've learned throughout this pandemic is that public health conditions and the virus do dictate what's next. So we sort of have to start there. And it seems like we're moving in the right direction, which is a pleasant change, that we have passed through, hopefully, the worst of this Delta virus surge, that global cases are waning and are actually looking like pretty good levels compared to what we've seen in the past. In the US, hospitalizations increased with the Delta surge, but remained moderate in many regions relative to where they were last winter. Fortunately, we had very effective vaccines that have reduced some of the worst impacts of COVID, so it's generally a better situation than what we were seeing before. Of course, the rise of the Delta variant and the sort of increased anxiety has impacted businesses and consumers and their thought process. So when you ask consumers in the next month, will the coronavirus situation get worse? So the orange line is people saying that they expect it to get worse, and that did uptick. It seems to have come down recently a bit. So consumers are watching the situation very closely. Some of the good news is that their confidence seems to remain relatively high. So I love this question, which is, imagine a good friend or a close relative asks you to take a weekend trip getaway with them sometime in the next month. How excited would you be to go? Right? It's a good objective measure of travelers' excitement. It's slipped a little bit with the Delta experience, but still does remain pretty high. So we don't know exactly what will happen next with the virus. It's very difficult to predict. It feels like it's going in the right direction. And so while I can't tell you what will happen, I can tell you what assumptions we're making as we look ahead. And we're seeing the fourth quarter here as being a period where public health conditions will stabilize, that hospitalizations will remain moderate in many areas, and that we have this backdrop of vaccine mandates, additional vaccines for children under 11, booster shots for higher risk population that are helping put more of a footing under that vaccine base. And that as we look towards 2022, assuming an environment that is not free of COVID, but where it recedes as a major cause of death. So there's still going to be a fair bit of risk aversion. There's going to be outbreaks and events that can continue to cause concern among travelers. But it'll be more like a bad flu season and better conditions than what we've had for the past year. Of course, variants could present a risk, a deviation from that. But generally, the assumption is that next year we have an improving environment for travel. Of course, it's partly dependent on what the economy does as well. So we start off with the question of, will the recovery continue? And so on Friday, we received the jobs report that gave us an update on employment in September. And after an August report that had been a little bit disappointing, September was certainly disappointing. We expected a lot more job growth in the US right now. There can be a number of reasons behind that, but it's clear that the labor market is sort of far off where it was pre-pandemic, that we have 5 million fewer jobs than we did before the pandemic, and it doesn't feel like there's tremendous momentum there in the job market moving forward. So on that measure, yes, it is an area that's going to take time to get this economy back to where it was before. But it shouldn't obscure sort of the underlying strength and momentum that is there. So our tourism team is part of broader Oxford Economics. They do an update on the global outlook country by country each month. I've been watching their US outlook very closely to see how Delta impacts it. And each of the forecasts for GDP growth has been coming down slightly. So it was very strong, the outlook in July. August was a little bit weaker, and September was a little bit weaker from there. The October numbers, which they just put out this morning, were just a step down from where we were in September. So not quite as strong as what they thought in July, but still very positive. Peak growth is sort of behind us, sort of that fastest economic growth is behind us, and that's why some of those jobs numbers do feel a little bit softer. But we have recovered to an economy that's larger than it was before the pandemic, and it's actually on a pace of growth that's faster than it was pre-virus. So it sort of seems hard to believe, how are we coming out of this with, by the measure of GDP, a faster, larger economy than we had before? Of course, a big role in that is the substantial fiscal stimulus that we had, over $5 trillion of fiscal stimulus that's been spent on the economy. So households during the pandemic generally earned more and spent less than they would have normally. And what that's done is it's elevated savings. So one measure of that is the elevated personal savings rate. And even through August, households are saving more than they typically would. What that's meant is that households have built up close to $2.5 trillion of excess savings. They won't, of course, spend this all at once now that conditions are improving, but they're going to spend a portion of it over time. So we think in the coming quarters, they're going to spend about 13% of it. And even just spending down that amount provides a tailwind, a substantial tailwind to consumer spending next year. In addition to that savings, we've seen the boost from home prices and equity market values, so that household net worth has recovered very strongly and quite different from the previous recession. Again, they won't spend it all at once, but it is a positive factor in consumer spending decisions, as well as household debt service. So in the prior recession, households had more debt and had more sort of payments committed to things like mortgages, credit card debt, than they do now. So as incomes grow, we expect more to flow through to consumer spending. And that's what we're seeing on the consumer spending figures each month. So this is major categories of consumer spending in the US relative to the same month in 2019. And what we've seen is households initially ramped up spending on durable goods. So the furniture, the patio sets, the vehicles, recreational goods increased. And so we're at a point where consumers are still spending 30% more on those sort of items than they did in 2019. And other services have now also picked up. So we've seen this rotation towards travel-related services, whether it's F&B or air or recreation, that's come back up to sort of 2019 levels over the summer. Both of these are very good signs of the strength of the consumer and that sort of backdrop of the savings and the confidence that they have. You wouldn't typically see consumers spending so much on durable goods in a situation where they were tremendously concerned about the economic outlook. So the takeaway overall in the economy is that there is a fair bit of positive momentum, and that next year isn't going to feel quite as strong in terms of some of the top line numbers, but it is still very much a recovery that's intact. So when will travel start to feel normal? Well, this summer was a big step forward. So we had, this is lodging demand as the blue line relative to 2019. We had July and August where demand recovered pretty close to 2019 levels, and we actually saw ADR that was ahead of 2019 levels. Of course, during this period, there's been concern of what would happen in the fourth quarter as kids return to school and there's more of a focus on business travel. Would we see a substantial setback in activity given that business mix? So that question's still out there, but the September numbers and everything we have to date looks pretty good. So September demand was just 6.8% off of 2019 levels, so not as bad as we had initially feared. But travel is very much varied across locations and fairly disrupted. So there's been, of course, the strong leisure performance benefiting resorts and less dense areas, even as dense urban markets still remain depressed. By hotel scales, right, of course, the economy hotels have benefited, but upper upscale hotels not having that business transient travel, not having as much group travel, have been negatively impacted. So we have this environment where there's this dramatic shift and disruption between typical segments of travel, with leisure travel well ahead of normal, business transient still probably 30% off of what would be typical, and group demand at least 40% off of where it typically would be. And the types of group demand that have come back are quite different than normal. So where does this go from here? We think that as health conditions improve, we're going to see normalization of those other sectors of demand, that we're going to see improved business transient and improved group demand, and that we'll see 2022 as a year overall, that will result in continued strong demand growth. So just to take a few of these in turn, how will business travel improve? Well, companies are gradually adopting to a return to business travel. Right now, about 2/3 of companies report that they are traveling. It's not back to 2019 levels, but it is some level of travel. Companies that have said, travel is too important to us to not have people out there. Where we saw the impact of the Delta variant was more on those companies that weren't yet back to travel, but were planning to do so over the next 3 months. So that sort of category did take a step back this summer. But if you look at them together, so you put together those that are planning to resume to travel and those that are already traveling, you find that about 75% of US companies either already traveling or plan to resume within the next 3 months. So there's a sense out there of the return of travel. What I find I place even greater credence in is the outlook for business capital spending. So the environment for companies spending on CapEx and other large projects is substantially different than in the prior recession. So last time we had this sort of grinding down quarter after quarter of companies trying to find ways to cut back on investment spending, and then spent a time there at the trough before companies sort of turned the spigot back on. This has been a much tighter, quicker turn, so the companies were quite uncertain right away what would happen in the recession and cut back, and now they've resumed that spending. And this is a good indicator of travel volumes, so that much of travel is sort of like an investment decision, that you're incurring a cost now, hoping to get returns later, whether it's getting out there to meet with customers or investing in training. So I think as we get through some of the public health concerns, there will be a good environment for business travel to resume. On meetings and groups, yes, it's been most negatively impacted by this environment. It's still substantially disrupted. It seems to be very much group by group, market by market in terms of what's happening. And the Delta variant has been another setback, that we saw a lot of cancellations in September, October, November of stuff that would have otherwise gone ahead. It's been a very difficult environment for groups to plan events for December, January, February, to sort of commit now for something that feels like an uncertain future. But as we start to look beyond that first quarter of 2022, we're encouraged that there's a pretty good base of bookings for next year, so that the pace of committed bookings is not that far off what a pre-pandemic year would have looked like. So that as we get further into the year, the group context improves. And part of that is that the vaccines have become available. So if you think about the typical audience at an event like this, is that college-educated audience, and the level of vaccinations among the college-educated is quite high. So this substantially reduces the risks for everybody involved. And I think it takes time for us to get used to the new norms, but that's happening, and so we will start to see that group activity resume. Sort of the last category I wanted to touch on was this international traveler. So 2021 was another year with very little travel. As Sebastian referenced in some of his slides, it's been significantly off normal volumes. We have reopening of borders that are going to help make a step up of activity in 2022. But we think this is the type of travel that tends to take longer to recover, those long-haul trips, and that it'll take until 2024 to get back up to the level of both inbound spending to the US, but also outbound spending from the US. So a longer period for the international travel to recover. But the takeaway overall is that we are in this situation where, as conditions improve, we expect this normalization of travel to occur and to bring back substantial volumes of travel that are not happening right now. Will a labor shortage restrain growth? So with that resurgence of demand, there's been a lot of situations where hotels weren't able to bring on enough employees to turn the rooms and respond to the situation in their local market. So how much is this going to be a restraint going into next year as well? I think it very much is something that's going to be with us for a while. And it's given the scope of what's happened here in terms of labor force shifts. So the hotel industry in the US let go almost 50% of its workforce during the pandemic. They've made substantial strides in terms of bringing workers back, but that sort of stalled out in August and September. And it's still far short of what would be normal. So some of that may be concern around the Delta variant and just what would have happened next. But it's also a sign of how difficult it is to find employees right now. So 1 in 10 positions at hotels and restaurants are unfilled right now. It's hard to find staff. It's hard to hold on to the staff you have. Operators are finding that they need to increase wages. So we've seen an 11% increase in hourly wage rates relative to where we were pre-pandemic. It's also interesting to see just how much wages were growing ahead of inflation even before the pandemic, that this is an area that it wasn't easy to find employees beforehand. It hasn't been made easier by the large shifts that have been underway. And so laying off that large number of people, not everybody was standing by, right? People went and found jobs in other sectors. Some of them have dropped out of the labor force, so that what we see is that the unemployment rate among people who previously worked at hotels is about 8%. And so there's not a large base of employees standing by trying to find these jobs right now. I think that this is the type of thing that heals itself a little bit over time as teams are rebuilt and restaffed and employers are able to find the employees they need, maybe at higher wages, maybe with changes in work conditions. Part of it's also going to be improved child care and reduced concerns. So when you ask workers in the US what's their main reason for not working, so people who are not currently working. What's the main reason for not working? And for a period here, it was caring for children not in school. But as we've seen schools reopen and remain open this fall, that constraint has declined a little bit. Also concern about the coronavirus has come down lower than it was previously. So there will be maybe some more folks coming back into the labor force and taking some of those jobs. But I think the takeaway is that with such a substantial change and with an economy that is also facing challenges in getting its workforce back, this is going to be a constraint that's with the industry for some time. So lastly, what's next for hotel pricing? In the context of sort of the broader reopening, there's been substantial increases in lots of categories of prices, but particularly used cars, car rentals. Some of these particular segments are driving increases in the consumer price inflation that are some of the strongest we've seen in decades. The view is that this will slow over time, that some of those price increases will be temporary, but that we are likely in a period here with a bit stronger inflation until we get into 2023, where things will start to normalize. Within hotels, it's been really, I think, a fascinating exercise here. That I just pulled out two chain scales to just look at them in particular. But so upscale hotels, like a typical Courtyard by Marriott, and an upper mid-scale, so a Hampton Inn, have recovered pricing strongly over those summer months. So the most recent data points are July and August. And you can just see how strong that was compared to the previous recession, where you tend to have that extended period of rates declining even after the economy started to improve. We had weak occupancy levels and declining rates. So it really is sort of an open question about what happens next. I mean, I think it's definitely a stronger footing to have seen this price recovery. It's a good testament to the flexibility, the responsiveness, and the professionalism that's been built into systems now that allowed that quick response to say, okay, we're seeing a lot more demand here. This is what pricing should be, rather than what happened in previous recessions. But I don't think we're sort of in this all clear situation in terms of what happens next, because the demand is not recovered everywhere. This is forecasts of room revenue that we do with STR for the top 25 markets. And so some markets have recovered. You think about a Miami or a Tampa is actually on track for room revenue this year ahead of 2019 levels. But there's other major urban markets that are 30 to 50% or more than 50% off 2019 levels. This is for 2021 overall. So in that type of environment where it's taking longer for demand to come back, I think there is still some open concern about what happens to hotel pricing without that sort of strong resurgence of leisure travel. Will it take a little bit longer for pricing to come back in those markets? So I guess if we're going to sum up some takeaways, sometimes a picture does it best. This is hotel demand per capita over the last 30 years or so. And I think the recent performance has really confirmed for me that these long-term trends remain intact, that this desire to travel is still there, and that we're seeing that play out. To go back to the four questions, the economy does have momentum, and the recovery still is intact. Disrupted travel, right? We're still in this fourth quarter is still heavily disrupted, but that as we move forward, things are going to start to normalize, and in many ways that normalization is going to feel like stronger growth. Maybe leisure is not quite as exceptionally strong as it was this summer, but still I think consumers are in a very good position. The hotel operating environment will remain very challenging in terms of supply chain issues and staffing constraints. And then hotel pricing gains, I think, are going to be pretty varied depending on whether the situation is one with strong demand or in one that's not quite there yet. So I'll pause there and happy to take some questions off of this. It looks like a good selection of them here, and we have a few minutes. Will it make sense that companies will resume business travel? Aren't most companies and employees eager to reduce the frequency? So yeah, I think there will be changes in what travel happens. And I think those are maybe the things that stand out to us the most, right? The trips that get substituted with a video conference, as we've all learned how to do. But I think what will also happen is a resumption of a lot of the activities that we were used to in the past, that those were sort of the most effective ways of getting together for certain types of events, and that we'll see a resumption of a lot of that. We haven't measured the impact of Zoom or similar tools on travel. Let's see, Okay, interesting question about property spend, whether that'll be higher or lower than pre-pandemic. Are travelers spending more money on property? I think that's one that's been varied as well, right? That operators right now have changed what they're doing to such a substantial degree, and consumers have changed what they're doing, whether it's closing outlets or trying to reduce that required level of staffing. And consumers are adapting to that, and how much of that resumes over time, I guess is an open question. I think hotel operators are probably looking for ways to make things more efficient, get by with fewer employees. So that could be one factor that substantially changes how much happens on property relative to what we are used to in the past. I'll take one or two more, and then if there's something that I didn't address, happy to have a sidebar conversation on those. So previous recessions were linked to market corrections. This one was linked to a pandemic. Any suggestion we might see another one related to normal cycles? Yeah, I think there's certainly the concern that an economic cycle with all this stimulus and everything that's happened, that you could then go into a phase where without that support, do things start to feel softer? Do consumers then start to get concerned? Do businesses start to cut back? And you get yourself sort of a self-fulfilling downturn again. Perhaps that scenario, coupled with maybe a resurgence of the virus, could mean that, yes, another cycle, we could go back into a more traditional recession. Always a risk out there. I think at the moment, a lot of what's happening is greater aggregate demand, right? The supply chain challenges or frictions in the economy, but it's generally that there's greater demand from consumers and businesses. So I'd certainly rather take that than the opposite. Are we expecting disposable income to be high in 2022? Will those traveling spend more? Yeah, I think that higher income households are in a very good position right now. There's a lot of pent-up demand. I think that they did what they could do over this last summer, and I think that they're going to be looking to do as much as they can going forward as well. So yes, I would expect robust spending as well. So I think I'll pause there, but thank you, everyone.